Okay, let's get into this. We wanted to really explore how you might analyze a stock like Benjamin Graham, using his classic ideas from security analysis.
Right? The foundational stuff. But then also bring in John Bogle's perspective from Common Sense on mutual funds, which sort of challenges the practicality of that for most people.
Exactly. We've pulled some key bits from your sources, these landmark books. The goal here is really to extract the core ideas, give you a feel for how these giants thought, almost like a beginner's look at fundamental analysis.
And then ask, well, how doable is it? Because, Graham and Bogle, both titans, both focused on long-term economics, but ended up suggesting pretty different paths based on what they saw.
So, starting with Graham, the sources make it clear. His approach in security analysis is like being a financial detective. It's that deep dive, fundamental analysis. He wants you to really get your hands dirty with the financials.
Yeah, the income statement, the balance sheet. Graham was almost obsessed with finding the true value of a company, often hoping the market price was way below that intrinsic worth.
And the sources highlight digging into earnings, right? Not just the number everyone sees.
Exactly. You have to scrutinize things like uh, non-recurrent items, those one-off things, gains or losses. That can make the regular profit picture look, well, misleading.
So filter out the noise, find the real ongoing earning power. And it wasn't just earnings, the balance sheet was key too. Assets.
Oh, absolutely. He looked hard at asset values, things like net tangible assets, or even more conservatively, net current assets.
The net current assets. Remind us.
It's basically the easy-to-convert stuff, cash, receivables, inventory minus all the liabilities. Graham would look for companies selling for less than that value, like a built-in safety net.
That margin of safety idea, buying a business for less than it's worth, even if you just sold off the parts. And he got detailed, didn't he? Inventory methods, how property was written off.
Yeah, incredibly detailed. It was all about understanding the reality of the business, its assets, its earnings, separate from whatever the stock market was doing day to day. Timeless principles.
A really solid framework for valuing a company. But then the sources bring in Bogle.
Right, and Bogle kind of looked at the track record of people trying to consistently apply that level of analysis, and, well, he had some serious doubts.
Yeah, this is where it gets really interesting. Bogle, who even Buffett admired, argued that for most of us, the key isn't super complex analysis, it's simplicity.
Radical simplicity. He basically said there's no secret sauce, just have a simple, long-term plan focused on getting the market's return.
And his big hammer was costs, right? The sources really drive this home.
Oh, massively.
Mm.
He showed how fund expenses, the expense ratio, often 1% a year or more, plus portfolio turnover, all the buying and selling inside the fund.
Which costs money every single time.
Precisely. Those trading costs, maybe, what, 0.8% according to the sources, plus the management fee?
Yeah.
It's just relentless. Bogle called it the tyranny of compounding costs.
It doesn't sound like much each year, but over decades.
It takes a huge chunk out of your return. And don't forget taxes, if it's a taxable account. All that trading generates capital gains taxes, further reducing what you actually keep.
So Bogle showed data, right? That most active managers don't beat the index after you factor in all those costs and taxes.
Yeah, compelling data. Very few consistently outperform, which led him to champion low-cost indexing. Just own the whole market, or a big slice of it, like the S&P 500 or the Wilshire 5000.
Don't try to be smarter than everyone else. Just capture the market's return minus very minimal costs.
And he did tie it back to fundamentals, too. He pointed out that long-term stock returns really come down to two things: the dividend yield you start with, plus the growth in company earnings over time.
The underlying business performance. And you talked about reversion to the mean.
Exactly. The idea that crazy high valuations or deep pessimism don't last forever. Things tend to drift back towards levels justified by those underlying fundamentals. Speculation fades, reality asserts itself.
Okay, so pulling it all together, Graham gives you this incredibly detailed toolkit for fundamental analysis, like the textbook on how to value a business.
But Bogle, looking at the real-world results, and especially those costs, argues that actually using that toolkit successfully, consistently, is really, really hard. And the costs of trying often outweigh any potential benefit.
Which leads him to say, for most investors, the smarter, more reliable path is just simple, low-cost, long-term indexing. Forget the stock picking.
Though interestingly, both are ultimately focused on the long-term economics, the underlying business reality, not market timing or short-term fads. Different methods, shared grounding.
So this dive really shows Graham laying the analytical foundation and Bogle highlighting the practical hurdles and costs pushing towards that simpler approach.
Yeah, it definitely leaves you with a big question. If those costs and taxes have such a powerful drag, this tyranny Bogle talks about.
And if markets tend to revert to fundamental value eventually anyway, how much time and energy should you really pour into that super detailed Graham-style analysis versus just capturing the market return cheaply?
Something to really think about based on what these giants observed.